If you have been following our tutorial, you should now have a good understanding of the basics of Forex trading, how to place orders and trade on the Forex trading platform, MT4, as well as the basic concepts of the Forex market. As we've discussed previously, there are two types of analysis, fundamental and technical. In this tutorial, we will focus on learning the basics of fundamental analysis, consider its strong points and evaluate the drawbacks, and finally highlight the most significant parts of fundamental analysis. Fundamental analysis has the following advantages. Fundamental analysis requires a lot of evaluation and research in order to understand the driving forces of the currency movements, and so can prove your overall knowledge and awareness of macroeconomic factors. Fundamental analysis is for the long term, and at the end of the analysis, there is a long-term view on a particular currency economy. This saves the trader time staring at the trading terminal for recent price moves, which allows him or her more time to work on other analysis. As fundamental analysis looks for the longer term and avoids short-term views, the view doesn't get affected by little movements in the market. This ultimately results in increased confidence. As we are more concerned about longer-term movement with logical support from fundamental factors, fundamental analysis can generate higher returns, which can be seen from the successes of the most renowned Forex analysts. The highest performing analysts are fundamentalists. Even though fundamental analysis has its benefits, it also has its limitations. One of the most limiting factors to fundamental analysis is the length of time it takes to get an overall view. It requires a long time to have deep understanding of the fundamental factors which makes it unsuitable for day traders. Subjectivity in analysis can also hinder the use of fundamental analysis, as different analysts would have different views on particular fundamental factors. Fundamental analysis is considered to be vague, as it does not recommend the entry or exit point of a particular currency pair. It indicates the general view of a market, which sometimes becomes unnecessary as a trade needs levels to trade. Since fundamental analysis is for the longer term, it does not indicate what could be the currency movement in the shorter term. It is best to use it for positional trading. Although fundamental analysis greatly assists traders in long-term decisions, day traders can also benefit from it. When a day trader understands the importance of certain economic events, this information may not lead to the trading decision, but rather to the decisions not to trade on a given day. Even though there are many fundamental factors to be considered for analysis, the following are the most important. Interest rates. In the Forex market, whoever sets the monetary policy or the interest rate direction for a country, generally the head of the central bank, is more important than the head of the country. By interest rate, we mean the rate of interest the central bank offers to park funds with them. It is also the bare minimum interest rate that investors will look for investing into non-treasury securities. Changing interest rates impact currency values, and traditionally, higher interest rates in a country would attract foreign inflows and strengthen its currency. In the same way, higher interest rates lead to lesser availability of funds, which in turn would increase the value of a currency, and vice versa. For example, on May 7th, the Reserve Bank of Australia cut the benchmark interest rate by 25 BPS to a record low of 2.75% in order to bolster economic growth. Fundamentally, this event indicates depreciation in the Australian currency against other counterparts. After the news was released at 2 p.m. by the RBA, there was initially volatility in the currency as the market reacted to Australia's economic outlook and the currency value lowered. Gross Domestic Product, GDP. GDP is the total amount of goods and services produced in a particular country, region, over a period of time. Reported quarterly, GDP growth rate is a primary indicator of a country's economic progress and is directly reflected in the value of its currency. A country's strong GDP figure tends to strengthen the domestic currency, and a weak GDP tends to weaken its currency. For example, on May 30th, the US released its second estimate of GDP growth rate for Q1 2013. The figure was expected to match the previous reading of 2.5% growth, while the actual reading came out at 2.4%. The actual figure indicated a slower expansion, and so after the release at 1:30 p.m, the market became volatile. After some time, the data started showing its impact, and the rate of euro-US dollar went up. An increase in the price of goods and services over a period of time is termed inflation. The rate of inflation is one of the macroeconomic factors that has a direct and significant impact on foreign exchange rates. Higher inflation reduces the purchasing power of a currency, and as a general rule, countries with higher inflation typically see depreciation in their currency, and a country with a lower inflation rate exhibits a rising currency value. But we need to also focus on the historical inflation rate while making trade decisions. If a country has been experiencing steady downfall in its inflation rate, it indicates a prolonged decline of demand for goods and services due to weak economic factors, which push down the currency of that particular nation. If the inflation rate of a particular nation has been witnessing a prolonged descent and then it suddenly gets an uptick, this indicates a positive signal. On the reverse, if a country has been experiencing high inflation rates and then a sudden decline, it strengthens the currency of that nation. Consider GBP Core Consumer Price Index figures released on May 21st. The reading showed a 2% increase in core CPI against the previous release of 2.4%. As the inflation figure dropped drastically to the lowest level since 2009, it indicated less purchasing power and signalled the Bank of England to continue fueling the economy with monetary easing. After the data was released at 9:30 a.m, the Great British Pound, the GBP, kept on declining against the US dollar towards the day low of 1.5112 from 1.5214. Employment rate. The employment rate indicates how much of the total labour force of a particular nation or region is employed. Employment rate has an immediate impact on economic growth. An increase in the unemployment rate or a decrease in employment is considered a sign of weak economic activity or a slowdown in the economy. High unemployment could lead to the central bank delaying increasing interest rates or even considering cutting interest rates, which eventually reduces the value of a country's currency and vice versa. For example, on May 8th, New Zealand released its unemployment rate for Q1 2013, which declined to 6.2% compared to the previous release of 6.8%, indicating an improvement in the labour market. The figure, released at 11:45 p.m, gave enough strength to the New Zealand dollar US dollar for it to rise from 0.8421 to 0.8468 in 5 minutes, and that strength was carried over to the next trading day. Trade balance measures a country's net imports or net exports and is a vital piece of economic information within the Forex markets. Trade balance shows the difference between the value of all the goods and services exported to other countries and the value of all the goods and services imported from foreign countries. Trade deficit occurs when the trade balance is negative. A country is importing more goods than it is exporting. Conversely, when the trade balance is positive, we have a trade surplus. The value of exports is more than the value of imports. Trade deficits are generally expected to contribute to a weaker currency, since there would be continuous selling of a domestic currency to pay import bills. However, a positive trade balance is seen as bullish for the domestic currency. Consider the Canadian trade balance figure released on June 4th. It shows the Canadian trade balance had a deficit of 567 million Canadian dollars against the previous release of a 3 million Canadian dollar deficit. The figure was released at 1:30 p.m. when the US dollar Canadian dollar was trading near 1.0314. After the release, the quote started gaining momentum to 1.0360. The widened deficit in the trade balance resulted in higher import payments than export receivables, which ultimately led to weaker currency. In Forex markets, political news plays a major role in the economic outlook of a country and can matter more than business news. An upcoming election is always a major event and can have a really big impact on currency markets. Whenever there are geopolitical risks or riots, currency traders always look for safe havens and ask questions later. Let's take an example of how Greek politics played a vital role in the movement of the euro from 1.2814 to 1.2067. At the end of May 2012, Greek election results came out with the conservative-leaning New Democracy Party and the Left Coalition Party winning the largest parliamentary support, but the winning parties could not form a ruling coalition. Investors were worried that the new government of Greece would not respond to tough austerity measures, which resulted in the euro-US dollar reaching a 1.2457 level, down from 1.2814. In June 2012, re-elections were held, which resulted in the formation of a new government. The new government supported the main austerity principles outlined by the signed bailout plan of Greece by the EU, but they immediately asked for its creditors to be granted 2 extra years, extending the deadline from 2015 to 2017, before being required to be self-financed, which ultimately pushed the euro towards the 1.2067 level. It should be noted that fundamental analysis is ineffective unless the exact time of the scheduled news announcements is known. It becomes essential to know the exact time when major and key economic reports are usually released. To know the exact time of the scheduled news announcements, visit the Forex calendar in Analytics section of our website www.admiralmarkets.com. Our Forex calendar shows all necessary information related to a particular announcement. It shows the scheduled date of release, time left for the release, the currency that would be affected from the news announcement, the news announcement itself, the importance of the data, the forecast, and the actual figure once the data is released. You can even change the date range to view the past and future economic announcements as required. Now you should have a basic overview about the fundamental analysis, its strong and weak points, and the key factors to consider. So now we can move on with the second type of the forecasting, technical analysis.